right. Good afternoon. Very warm welcome from the enmacc offices here in Munich. We are back with a special episode of our Digital Traders Summit series. Today we are tackling the questions, are PPAs ready to trade? So what we essentially want to do is take the trader's perspective on the PPA market and PPAs in general, which is a widely discussed topic, and we are really happy to have a lot of participants. I've seen more than 700 people registered for this webinar. So we are quite pumped here to share this time with you. Look, before we get into this, it's a little bit of a special episode as well, not just because we have so many participants. Two things are different than normally. We have not just one guest, we have three guests joining us with their expertise and waiting for your questions later on. And we will make an exception and talk about enmacc as well. So as we are moving in the direction of PPAs, we want to share a new product offering, which we are launching in the next days. And we'll spend a few minutes on this. My colleague Volker will join us for the presentation. So now let's get into it. We have three guests, as I mentioned. First, there's Libby Rust. She's joining us from Shell's power desk in London, trading PPAs to power, have a wide expertise and range. But yeah, not being an originator, but having the trader's perspective in bringing this in. Then we have Robin with us. Robin Girmis, he is energy weather, a kind of well-known consultant to anything energy, to energy traders, and as well enwex, the home to the enwex index, which we'll come back to discuss later. So thanks, Robin, for joining us as well here. And last but not least, Max Amir Dieringer from FlexPower. FlexPower is known to many of you, I think, as a highly innovative trading house, a small trading house, stirring up things sometimes, having opinions. That's why we have him here, and I'm really happy that he completes this round. And what we had planned for today is actually three parts. Quick discussion. We had prepared already some questions to tackle the wide picture, the big picture of PPAs, going into some more specific topics from a trader perspective again. How can we integrate renewables and PPAs more into the wholesale energy market? That's the bigger theme. Then we have a short presentation from Volker, giving us a quick look on what we are developing right now on the platform. And having shared all of that with you, we invite you to, as always, join us with questions. Use the chat functionality. I will pick up the questions, put them a little bit in order, and let us know if you have a specific person in mind whom you want to address. Otherwise, I assign it and we have a conversation. So to me, always the peak of the discussion. So your questions are most relevant, and that's why we have our guests today. All right, let's get into it. Thanks again, Libby, Robin, Max, for joining us. Starting maybe with a very broad and general question. How do you look at the PPA game right now? What are the big trends and developments you see? Maybe, Libby, you want to start?
Yeah, I can start. Thank you, Jens, and thank you, enmacc, for having me today. So when I'm thinking about PPAs and long-term physical PPAs, which is it's where my greatest exposure is and where we are most active participants, the key trends are in response to challenges of the energy transition and those physical electrons. So three trends come to mind. The first would be price cannibalization as a result of these rapidly decreasing capture rates. Even last month, only 30% of baseload value was captured in Germany for PV. So yeah, it's a huge trend, and it's also a huge price trend which the market will need to respond to. A second element that comes to mind is increased volume risk. Again, as a result of the energy transition, we are seeing increased negative prices, and we have a lot greater risks associated with larger curtailed volumes, with traders currently managing these risks, and we are developing PPA solutions in response. Alongside this, another element of volume risk that has been derived from the energy transition is also from grid congestion and stabilization mechanisms from the TSOs, which is exacerbating that differential between P50 and realized volume, and it's something that we're looking to manage actively, obviously. And my third trend would be around the regulatory response and the core uncertainty derived as a result of this transition. Something that comes to mind is the power price for industry, with a pretty uncertain subsidy, which is having an impact on our customers at the moment.
So we see here regulatory environment, a lot of weather effects. Robin, I guess that's your stronghold.
Yes, indeed. I of course have the weather glasses on that questions, and from my point of view, weather became a key driver on power prices and power price settlements in recent years, but especially valid in last year and this year. With maybe sometimes the merit order having a bit of issues or fundamental price analysis having issues how to price it along merit order. The growing renewable share on power production has a print. And from my point of view, markets so far lacking any liquid hedging product against at least the anomalies in that setup. So if it's especially less wind than normal or anything, market has nearly no chance to mitigate if he sits in a PPA. They include a weather component, and a standardization of PPAs could really help out markets to mitigate at least against the weather volatility.
Understood. Yeah. Max, what's your
So you asked about trends. These were all points that are, I guess they've already we're already seeing them in the market. So everything that just mentioned now is already a bit of a given. I want to take a bit of a step back and go a bit more global and actually make a call on this. And I think so my call would be that PPA markets are going to move away from being like an ESG product, a premium ESG product, because this is really, you know, what they used to be, what they maybe still are, and they're going to go into full commoditization mode. This is going to be my prediction for the next few years on the origination and hedging side. Also, and then the fact that we now already have them, the standardized products, but we will have, you know, more liquidity on them, and, you know, they will be traded on enmacc and all that. So this will also allow for risk to get shifted just a lot more efficiently compared to, you know, what's currently the case, like what Robin just described. You originate it, and then you mostly you just sit on the risk because you can't really manage it at all. And we are actually already seeing this from the funnily enough from the asset owner's perspective, because that's really still what we're mostly dealing with. And they're now trying, because we are already offering these products to them, and they're super interested. They're now starting to wrap their heads around it. And you know, there's a few much more sophisticated hedging strategies out there now that our clients are using, and this is all based on the fact that we now have these standardized products, and based on the fact that we can now offer it to them. So I think this is also a huge enabler for the production side, who you know, in the past they haven't been the most sophisticated ones when it comes to you know, risk monitoring and risk managing and all that stuff.
Yeah, I mean, the move to standardization comes usually with a simply better understanding of the risks involved and how to capture them. Maybe continuing with that with Max, you say some of the effects here, like curtailment or negative prices, capture rates, etc., they're not brand new. So we're dealing with this since a couple of years. But do you see still certain risks which are overlooked by traders, buyers, sellers, or let's say undervalued, not fully understood yet?
Right. I mean, especially I think in the corporate PPA space, which, you know, has been a decent chunk of volumes that got exchanged. I think commodity risk in general has been overlooked completely, and all the risks that Libby mentioned, curtailment, which is, you know, based on market prices, redispatch, so grid congestion. No corporate off-taker would ever understand what that even means. Like, they probably don't even know what it really means right now, even though they're already facing they're facing the problems that they've, you know, bought themselves into by just procuring these PPAs. So I think the risk has been overlooked by buyers immensely. So and you know, I called it that in the past too, like a feel good and ESG has landed on private balance sheets, and it's also put the system, you know, it has put additional systems risks on the system, because I mean we're seeing this now, and Libby mentioned this as well. PV market values, right? They've just crashed immensely, and there was just wrong incentives in the system. There wasn't real price discovery. So I think like just the mark to market and the settlement on these deals it doesn't look too good. And then there's all the regulatory and all the curtailment on top of it, which they've definitely overlooked. Yeah, so I think that's been a problem, but we're trying to change this through more transparency and again more commoditization in general.
Yeah, understood. Specifically the weather risks, Robin, be frank here. What is the state of the play here? How good is the understanding now by traders or parties involved in PPA transactions right now of the weather risks?
I think in the long term, so longer term contracts often are connotated to also have less volatility, than shorter term ones. So then they think, okay, in the long run, it will average as we decided to take our PPA. But in fact, you have, from my understanding from PPAs, a sensitivity on both sides. On the one hand, you have, as Max just mentioned, that I just start with fuel prices in 22 situation. You have a risk here completely to lose in the stack against the generation costs. So suffering on a capture rate like this if fuel prices are too volatile. On the other side, weather is also volatile, and weather can have also quite prolonged stretches of anomalies, fluctuations. So low frequency modifications compared to what we're used to, maybe from recent 10 years, maybe from last year. Let's say traders mind usually having a bit more the shorter periods in mind, but comparison this year's wind to last year's wind in Q2 is quite a difference.
Yeah. So we
So
have
it's
these
sensitive from both sides without ability to mitigate.
Again, if we take the trader's perspective, maybe very simplified view, but let me ask you still, how do you compare at the moment trading or closing contracts in PPAs, and how do you look at baseload or more established wholesale contracts? What is the difference? How do you treat them differently? How do you price them differently? What is the current status you see there? Maybe Max, you want to start?
Sure. Well, I think always this is a bit the differentiation between trading and origination, I guess. For a trader, liquidity has pretty high importance, and price discovery is important as well. And something like that, like proper price discovery, you can really only get if you have a standard product. So speaking from like the view of a trader, us traders, we do have a view on forward phenomena, right? That's exactly our job, to kind of, at least, we don't know what's going to happen, but we have to have a view on it. We kind of have to anticipate that there's going to be more curtailment, that there's going to be more grid congestion. And this is something that we've actually known for years now, that this was, bound to happen. So again, this is our job to know. And then having a standard product in general just allows everybody that has a view to more efficiently trade against that view. And this in turn will provide actual liquidity and then benefit everybody in the market. So this is how markets do work, and also how they're supposed to work. And just it's just easiest transported and transferred and made available or made lit, as you could say, with a standardized product on back of it.
Yep. Libby, you're part of the power team. I introduced you already like that. You're part of the desk trading all these standard products, maybe algo-based as well, and then you're dealing with PPAs. Explain us how that fits together and where it doesn't fit yet.
So I can add to that. I agree with Max in the sense that, of course, liquidity and standardization will reduce friction and hedging costs and enable a more seamless liquid market. At the same time, the underlying assets are very physical, and that in nature is extremely far from a baseload contract. Intentionally, the long-term PPAs that we are seeing in the market are extremely bespoke to maximize the value for clients, and also to maximize the value for specific assets with different technical constraints. These long-term agreements carry a lot of credit risk and a lot of counterparty risk with the lack of any secondary market. So it's an intentionally very different product. This is not to say that a more commoditized liquid financial hedging opportunity is not extremely valuable. That is enables us to de-risk these assets. And the lower the hedging margin, obviously the more profitable these electrons are going to be.
Well,
Yeah,
maybe
sure.
one point on this. So Libby,
Yeah,
you're, of course you're not wrong, but I think also the key and the key in what we've tried to do and the key in what enmacc is doing now with actually putting the product on the platform is the de-link between the idiosyncratic risk and the part that you can actually standardize, and then like taking the idiosyncratic risk, like the asset bespoke risk, okay, like the risk that's really linked to an asset, like you said, it's a physical deal, really delinking that from the forward perspective, right? I mean, this is exactly the same thing we have in the in base and peak load as well. We have base load and peak load production facilities. But if I'm trading a standardized product, I might still trade against someone that's running, or if I trade a peak load, I might trade against someone that's running a peaker. But it's not necessarily the case for the person that's is long the physical asset at the meter, the idiosyncratic risk. That risk for them, it doesn't go away, but still the standardization is the only vehicle for them to really shift the risk around the physical asset bespoke exposure that they have. So I think this point is super critical also for everybody that's listening today to understand really because there has been a lot of talk about PPA standardization in general, and people have said it's not possible because you're dealing with assets. Yeah, of course you are. This will never go away. You're dealing with curtailment on a grid, on a subgrid level that's linked to the asset. That will never go away. But that's exactly a route to market provider's job to manage that. But what you can do is you can delink this forward component completely from the asset, and therefore you have part of this PPA risk, part of that forward risk, which is super important, has huge leverage because it has long tenors, etc. But you can really perfectly delink that from the actual asset, and I think this is an important point that everybody should understand.
And one element of that is as well having a perspective on the asset-specific weather risk, if you wish, and transferring that into an index, which can have a good kind of correlation with the individual risk, if you wish, but can represent that nicely. Elizabeth, Libby, I see you nodding as well. Are you using already the indices, and what is a good index, and what does it have to provide in order to be useful and find sufficient penetration in the market?
Yeah, thanks. We find these indices very useful for increased liquidity on capture rate risk and exposures. The main attributes of a useful index will be transparency, reliability, and the ability to forecast what the index will doing. So we're able to manage those positions in the prompt. I think in terms of how to drive adoption, it's obviously always going to be a trade-off between the diversification of the index giving liquidity versus a more specific bespoke location and assets, which may give you a better hedge. And I think that's obviously a hard line.
Where do you see the balance? How do you deal with that?
Yeah, well, over to Robin. Let's hope so.
Robin,
I have a super clear view on this.
Right,
liquidity is always key. So it needs to be about hubs. It needs to be a rather easy and not very bespoke, not very detailed index that should, speak to a lot of people, because again, liquidity is key. Without liquidity, you can't have a market, and everybody just wants to trade against the best liquidity, even if their basis risk, if the risk against what they have in their books and the mapping to the actual hedge is a little bit higher. You still want to have liquidity when you exit the position. You want to have liquidity when you get out of the position. So just making things more bespoke it's always a risk on the entry. It's a risk on the exit. So I think for me that's and it's been like that. I've had this view for a long time. Liquidity is always key.
Yeah. So good enough is a good trade-off for good liquidity.
Good enough is perfect. Exactly.
Robin, you have heard it now.
From
30
just
seconds.
picking up that perspective, from my point of view, you can take any site in comparison to your country, similar as with power prices. You have any asset which is maybe a bit more efficient or worse in efficiency on the gas or on the coal, and you somehow hedge against sparks or darks. So it's a bit similar for weather. If you have a wind turbine situated somewhere, let's say in the northeast, you know about its relative performance to the German-wide mean. Yeah? So you know about the plus minus stuff in general due to your investment. So this on the one side, maybe from the accuracy. The other thing, exactly, this is a sweet spot we dealt with. Yeah. So we had to structure things, let's say, being accurate enough meaning in terms of correlation, RMSE, whatever you wish as a key to measure accuracy. But on the other side, especially as we wanted to create something being tradable, reducing complexity. And this is especially valid for the meteorological point of view. Yeah? So we kept out, let's say, 90% of all that meteorological issues and formula and orientation of solar west, east, southwest, and really got to the basics. Okay, is it sunny or not today? Is there a high amount of power produced? How will it impact my market? Yeah? And we had now, such simple approach from our point of view with enwex, please tell me if I'm wrong, that we avoid that black box stuff. Traders hate black boxes. And this is what was in the market so far for weather trading, mainly very complex creations for indices, which are not really copy pastable, or the trader did not understand what the index really came from. We have completely transparent published each step we do on the calculation of the index and on the yearly review, how to mitigate to new bid of new capacities and potentially slightly changing spatial weightings per country. Yeah. And it's scalable this way.
Yeah, the simplicity mattered to me as well, most honestly. When we looked into different kind of approaches to indices, etc., I think this kind of transparency and simplicity, even if it comes at a cost for perfect correlation, as Max said as well, but I think it's an ingredient you need for liquidity. So as a platform, we have to push hard to this kind of simple solution and give it a try. Yeah, I mean,
maybe just to add here, no? So if we talk about accuracy, if we talk about figures or so, we have now 12 points representing wind or solar for Germany. So these 12 points have an R squared of more than 95% compared to NET's transparency data. If you take this and compare to other indices, they're not even 1% better. And none of them is meeting 96%. So the loss in accuracy is really marginal.
Yeah, absolutely understood. If we step back a little bit and look at the wider process of transacting PPAs right now, and coming to you, Max, and Libby here, what are the biggest impediments or frictions along the process you see right now from keeping you back from trading that more efficiently?
So I'm probably a bit biased here, but like I haven't seen any PPA trades really in the market apart from what we've done at FlexPower, because we also sell it like that, we frame it like that, we built the product like that, that it's really a little bit more of a trading product than maybe an original of an original PPA. But I think just being able to buy and sell flexibly, like renewable shaped power and bespoke, and also cascading tenors and closing the deal with physical delivery or financial settlements, and doing all that within a few minutes is like that's how we've gone about doing it. And I think in general, with everything that's what PPAs used to be like, is the biggest blockers have been like transaction time and absence of liquidity, and really the absence of firm prices that you can reliably just transact against. And again, this is exactly what we've basically built at FlexPower. I think in last year we had we've done over 300 deals and PPA trades, if you will. Like there were small trades from small size to short tenor to longer dated and higher capacity kind of stuff. But you said it before a bit jokingly that we're a small trading house. Like we're not one of the big players. So I think like our balance sheet is super restricted, and we were able to showcase that PPA trading is actually possible. So I think others and bigger players, they could be doing, you know, thousands of trades a year, really, if they wanted to, and if they, you know, get behind the concept. So I think, yeah, huge chance for everyone to just, you know, try to understand what's going on, how it's supposed to work, and then if you have a good balance sheet, that's you can do a lot more than, you know, than we can. Other than that, I would say, you know, big frictions are also, but I've already talked about this beforehand a little bit with the idiosyncratic risks and the asset bespoke kind of contractual structures, which, you know, always takes time in an asset-backed PPA contract, because you do need to talk about things like curtailment, redispatch, availabilities, and things like that. I think these idiosyncratic components do get discussed too much, because really, and again, if you have a standardized market that you can rely on with respect to price discovery, just pricing in all these special asset bespoke restrictions or situations is actually super easy. So I think people, you know, they oftentimes talk, you know, too much about curtailment and redispatch and availabilities and things like that. If you come to us, we can give you few options. You always get a price for it. So with us, it's really always, you know, already implied in your PPA price, and so we think it's super easy to actually price it in. But again, then this is all based off of like having the index-based PPA structures to begin with.
Yeah,
That makes
understood.
sense.
Clear view here. On the one side, FlexPower, on the other side, Shell. Yeah. So
Yeah,
is that the same world, the same perspective you have on the market?
Yeah.
Right?
Obviously coming from a very different angle, with likely very different customers. What we're seeing as a friction is, at the moment, increasingly complex assets that we are pricing and modeling that we haven't experienced in a high volume before. So the something that comes to mind is obviously the trend towards co-location between PV and BESS, where we have increased complexity with no standard configuration of the storage. Obviously, many more revenue streams, and then for increased transaction times with a more bespoke product. So that, for me, would be one area of complexity that is keeping us very busy at the moment.
I think that's a good point, and that's super interesting, and maybe a bit of hubris from my side here, but that's also something that we've, you know, dumbed down quite a bit, and I think we've come up with a very, very simple and straightforward remuneration model also for co-located assets, because it's really not that hard. You have a PV, you have PV in feed, you have some flexibility exposure that you need to remunerate. You need to optimize it accordingly. It's just, you know, a modular building block of kind of offsetting exposures, if you will. So yeah, also here again, based on all of the standardized stuff that we're already doing, we've come up with, you know, super straightforward remuneration models for these more complex, which, yeah, you're right on that. These assets are more complex, especially with respect to technical restrictions and things like that. But we've come up with a quite straightforward and yeah, almost standardized model, even on the asset level, if you will.
Look, isn't that what makes it so interesting, that at the same time we have new complexity for batteries and weather challenges as well, and on the other side we have a move towards standardization where risk gets sliced differently and addressed and transferred differently. Both can happen at the same time, and I think make it super interesting. And that I can say, as CEO of enmacc, since many years I get two questions I always get is, one is when do you attack Trayport? The second is when do you go to PPAs? On the first question, I don't say anything today. on the second one, I can a little bit shed a little bit of light on that. I don't think that the traditional long-term PPAs are a platform business. Full stop. There's others who try it. Wish them luck. We come from a trader's perspective, creating liquidity. Our business is, we are in the business of scaling things which work at heart. So we have seen it proven, and yeah, Max, I think FlexPower is one element of that proof point, that you're training these products already, then bringing them on a platform and actually trade. And we are not digitizing now or bringing classical PPAs on a platform, but what we would allow is an integration of renewables PPAs into the wholesale market by addressing the key risks in a standardized product. That's what we are up to. So providing hedging products which allow us to address specifically the capture rate, which has been much debated. In the past, we had seen dramatic developments. There's a lot of speculations ahead. Yeah, what is faster, the build out of solar, or is it the build out of batteries? And this lends into a nice and interesting discussion for traders, because you can have different opinions of this. Max, you want to, yeah?
Right. So that's a super good point, because that's again with the opinions and the price discovery and the speculation. Yeah, the analytical speculation, everybody can, wrap their heads around it, and that's, you can philosophize for days if PV grows quicker than flex or whatever, but actually having forward liquidity that you can trade against, that you can hedge against, also from project developer perspective, is super, super important. This is key to even being able to build the project to begin with. And we haven't really had that in the last 5 years. And now we're seeing PV capture rates, market values at below 20 euros per megawatt hour. I guarantee you, had we had a proper lit or semi-price discovered PV product 3 years ago, this wouldn't have happened, because there would have been a lot more flex developed against locking in the PV merchant risk and building their projects forward. So this is also a bit of a feedback loop, right? And this is super important. And I don't think not everybody has understood this yet. Also, like not the regulators haven't, but like even market participants, right? So,
no, but market participants, we want to
exactly. That's
this discussion. I couldn't say better. And this is the moment where I would love to hand over to Volker. Give us a very short view on what we have built addressing this capture rate risk everyone is facing, and how markets, or specifically enmacc, can help hedging this and trading with it and providing more transparency.
Yeah, hello everyone. So I'm Volker. I'm currently responsible for bringing this, so to say, go-to-market together with plenty of market participants who show strong interest. And I will not go now into details or so, but I basically want to share with you the motivation of ours and as well from the market participants. So, I mean, as you all know, the issue currently is that you can't really hedge solar and wind assets in the forward market. I mean, you can trade baseload, you can trade profiles, but ultimately you will not know on which day, in which hour you're going to have a lot of production or low production. And this is getting even worse, because like when you have underproduction, you need to buy against the hedge you've done in baseload or profiles at a high price, your electricity. If you have overproduction, you have too much, you can sell it, but you will not get a good price for it. I think that's very, very clear for everyone. And what we ultimately need is a product kind of matching the production based on the weather, matching the production of solar and wind units to allow to trade ultimately solar and wind. You could do this as already discussed here. I mean, you could, of course, trade a PPA, which might be still the best option for certain, let's say, I don't know, off-takers or renewable producers. But they are bespoke, they are complex, they are pretty illiquid, and ultimately they are also sometimes difficult to price. And so there's no real efficiency when doing these contracts, especially for hedging reasons, when you want to hedge a portfolio, or also if you want to go speculative long or short in the solar and wind production in Germany. So what are we gonna launch very soon is that you will be trading a standardized contract against solar and wind Germany, which represents the German wind or solar production in each hour of the day. And the product will be based on the enwex index. I'm going to come to that in the next slide quickly, how that works. But that is the idea behind it. So you reference against an index which replicates the current solar or wind utilization in Germany. And the beauty of the enwex index is, and the product is, that you can trade it physically and as well financially settled. Most probably the big companies will rather go for financial settlements, while we already heard from plenty of smaller companies saying, look, I only want to do it physical. And you can do this because the enwex index calculates and provides the results at 10 o'clock in the morning for the next day. That means that you're gonna still have 2 hours before the spot auction. Now let's have you look on the enwex index, a quick look. Yeah, Robin already mentioned that. So you have 12 grid points. They are weighted based on the installed capacity in solar and in wind. You calculate the average, and then based on the weather, ultimately wind and solar, you're gonna get a result for each hour. How does that look like? That's just an example. So let's say, for example, you have sold 100 max Cal 26 solar. The price is pure fiction, but you have traded that, for example, today at 40 euro 50. And this is an example day, example settlement day for physical product. So let's say we have June.
Quickly, Volker, are there supposed to be slides? Because I'm not seeing any. And
You're not seeing it?
Someone just asked in the chat.
Okay, sorry for that.
Oh, perfect.
Okay, but let's maybe quickly jump back. I'm sorry for this. I thought, because it showed me that I'm sharing it. So here we go with the index. These are the 12 grid points. This is how they are weighted currently, and you calculate the average to get ultimately for each hour every day a result, and the result is published at 10 o'clock in the morning for the next day. And this is how it can look like when you trade physically. So you get the index result, you multiply it with the traded capacity you've done in the forward trade, you get a volume result, and ultimately the seller needs now to deliver that amount of electricity at the fixed price of 41 euros 50, while the buyer needs to offtake that amount of electricity at that price. And you can do the same with financial settlement, where we reference against the hourly spot auction price of EPEX. It's a very simple product. Again, the beauty of it is the flexible volume. So you trade a fixed capacity in the forward market, you lock in a price, but the volume is flexible based on the enwex results. And how will it look like on the platform? I guess there are some people which are maybe not so aware about enmacc. So enmacc is an RFQ trading platform. So we have here these cards where you can very flexible define products. And what you can do here is you can either trade solar or wind as an outright trade, so as a single leg, or you could also indirectly trade the capture rate by adding a value hedge in baseload against it. So in this case, then you need to sell solar. You calculate the value hedge based on your personal assumption of the load factor, the capture rate, and then you send it out. You get the prices back. You can also put in limits, and the beauty of trading such a spread is you can keep it out the whole day. You don't need to adjust it despite baseload is moving. And ultimately, if you want to trade it, either on the recipient side here, you can accept one of the limit orders, or I don't know, you send the price back, and the initiator of the RFQ trades the price. So it's this very simple thing. Again, the beauty of it, we are really building here a network. We have a very long list already of companies with the intention to trade it. We already have plenty of companies which are already ready to trade such products. They want to provide liquidity, they want to initiate, and everybody is invited to join that, hopefully, movement.
I mean, this is amazing. You can now trade PPAs. People said it wasn't possible, but there you go. You just saw it. It's amazing.
Great. Love that. Volker, thanks for giving us a glance at what we are working on, launches in the next weeks. Do we have a concrete date? Volker, I should know.
I think it's the last day of June.
Wonderful. Wonderful. We're coming around the corner. We have already many companies lined up. Many more even here in the session. So we received a lot of questions. I just worked through them. I hope many of them we have addressed meanwhile, but I still would pick up a few of them. One of them was maybe, Robin, from your perspective, coming from trading, now being on the energy side, there's the net transparency data as well in the market. Give us a little bit of an overview where an index like yours is serving the market better than the official net transparency data, which we're all aware of is as well good and reliable source. You know?
Sorry, no. I think the net transparency is the authority in this day, but when does it publish data? Just on a monthly granularity. We just saw the example on going into hourly volume modified positions based on a PPA. That's not possible with net transparency data. That's a key point.
What's
yeah.
the volume on nets? Nobody knows. It's a black box. You get the price. You don't know what kind of volume is in there. How are they dealing with redispatch? What's going on with curtailment? It's like the fact that we're even basing settlement on this is just because it says it somewhere in the law, and then someone just some official party just calculates it. But it's never supposed to be a trading product, and it never will be a real one. So I mean, I've heard these arguments a lot, and I just totally disagree, because yeah, you don't have the volume. It's 100% black box. You can't run a physical nomination day ahead against it. It's like, yeah, it's just something completely different. And then it's not. It's basis risk, and it's super related, but having a transparent index is just the cleaner way of doing it, because you can do so much more.
Yeah. You're basically extracting as well the balancing risk, no, as we take the day ahead values, which makes it a cleaner product.
Right.
And as well, a very reliable product with a huge history of how many years, Robin? 25 years?
Yeah, we have to split. So day ahead forecast histories we have since 2013. If you want to have a climate change trend embedded, for example, in temperature or whatever parameter, then go back to 79. We have error data, error 5 data also. So a history of 45 years in total, with the exact index calculation and behavior since begin 13.
Maybe we're not going too much into technicalities, but we use as well the day ahead forecast for the prices. One question coming up here, maybe, I guess, Robin, you can address that as well best. 15 minutes trading is on the rise or coming. How does that fit together? Are we switching to 15 minutes as well, or is it the 1 hour?
It is possible to switch to 15 hours by just interpolating, not by the weather input. The problem is the underlying weather model has an hourly granularity. In Australia, for example, it's 5 minutes, 10 steps for power pricing. They also deal with hourlies here with enwex. But of course, we could linear interpolate, which is just a minor issue for solar, no issue for wind.
Wonderful, yeah. Picking up more questions here. Libby, in your direction, maybe there's a question, well, what kind of tenors do you hedge PPAs today in today's world? What kind of tenor would you see for such a product? Are we talking of a visibility of 1 or 2 years, or can we go longer? What would be your expectation how this evolves?
Yeah, thanks, Jens. I think it completely depends on the hedge, obviously. If we are looking at a market-based product, there is a limit in terms of the liquidity, which has obviously been discussed. But whereas where we operate as a trading company is to leverage our customer base, where we have strong appetites to align with ESG goals and to deliver green electrons that are asset specific. So in that vein, yes, market liquidity is less of a constraint.
Maybe on this, I would say you can comfortably go out 5 years easily. You could do even longer, but 5 years, 1 to 5 years, quarters to 5 years is the perfect playground to start with, I guess. That's what we're doing too.
Wonderful. So Max is there. We just need someone want to trade with him and maybe test him on the 5 years. Not so sure, but we'll get there. Very good. Max, there were questions as well about what you said about what is the asset specific risks and the kind of forward or standardized risks we see in the wholesale markets. To elaborate on that, maybe again a little bit repeating where you draw the line there, and then specifically one question was regarding counterparty risk. How do you deal with that in a traditional PPA world, and how do you deal with that in our trading world and in bilateral trading?
Sorry, is this question now about basis risk or credit risk or both?
I guess both.
Okay. I mean, so, and then the question was about like, what is basis risk, or?
No, what is the asset specific risk you see, which leads to, let's say, a 100-page contract versus what is the core, which can be the content of a tradable product as we
right. So I mean,
what's left out?
In the easiest way, if you have an asset and you need a route to market, you will always have an asset specific contract, right? You need the route to market, you need the balancing, you can index the balancing to some you can do a fixed price, or you can spot index it or whatever. That part will never go away. But and yeah, it can be 100 pages, but I think our contracts are like 20-25 pages on that part, right? So it doesn't have to, like I said before, it doesn't have to be too complicated. But anyways, this is just the route to market, direct vermarktung, which every asset kind of needs, right? Then if you stay into this, if you stay in this PPA logic, in the standardized PPA logic, if you think about just putting an index overlay hedge over your actual consumption profile, okay? Let's say you do this route to market contract at spot or reference market value or whatever, some spot index price, and then you're going to put a calibrated standard index PPA hedge on top of it. You've created a PPA for yourself that's going to have some kind of fixed price component to it, right? There's going to be a bit of a risk between what your asset is actually going to do and what the index will look like, the calibrated volumetric structure. But like your hedging ratio, is 80, 90, whatever, how many percent you can look at that with respect to, the infeed data of your asset. And all that. So that's not real rocket science, but that's really the concept behind it. Okay, just this is what I meant with delinking this forward and spot, or this idiosyncratic and forward component from one another, right? They're a little bit unrelated, and with this index logic, you can actually you have this firm delink between what's actually happening at the meter and what you're doing on the hedging side, and it's totally unrelated, right? And then maybe related to this on the credit part. Now, technically, you could do the route to market with me, and then the index hedge you can do with someone else. You can also do the route to market with me and the index hedge with someone else through me, because we are connected on enmacc. So we're just going to, take it out the door and trade with someone else. And if you trade with us, you will always trade against the best liquidity in the market, which is essentially what you would want, right? It's like me asking 25 other traders for what's their view on the forward. You can still compare me on the balancing. I'm going to be hopefully the cheapest on the balancing side. I'm going to pay you the most money for the flexibility premium, for example, that we're paying in case of curtailment. There's just a lot more comparability, and at the same time, you're always guaranteed to basically trade against the best price in the market. Okay, and this is just possible through this delink. And then on the credit risk, so if we're doing the index hedge for you, basically indirectly, because we're going to be trading it on enmacc, then I have to manage the credit risk with whoever I'm trading with, right? That's just a bespoke kind of situation. Under EFET, we have certain terms. Maybe we have some step-in rights into the asset contract to alleviate some of that collateral requirements or whatever. If you go through enmacc yourself, and maybe you do it financially directly with the other counterparty, then you have to you're going to have your own credit terms, because then they will margin you on the financial deal. So most of the time, it's actually easier to do the physical and the overlay in one go. But you're super flexible from asset perspective. Does that make sense?
I think I would add maybe that as normal trading on enmacc, you have a framework contract in place, regulating your relationship, and that's your price in credit risk, as you would do as well on a baseload. Right. A few cents on top. Basically, that's the practical solution. And I think that still, with enough liquidity, gives you a very competitive pricing and access. That should work. Robin, we got one question to make it more tangible. We had this kind of wind drought beginning of the year, in Germany, special event. You mentioned that as well. A little bit out of the range of the foreseeable, maybe, or planned. How do such a product help mitigating that solution, or how could such a product help in this case?
Well, tricky, no? Depending on which side you are. So of course you don't earn that same amount of money as you have less volume to sell. So that's the one side. The other side is, if you have to compensate in a PPA, then you of course have to buy the remaining power at the market, probably at higher prices. So obviously not the best situation for you if you provide the power in your PPA. It might be a bit easier in such a case to directly trade the volume to really have change in your balance sheet. But on the other side, yeah, you have to rehedge. Yeah? You have to think about your expectations of the wind and to mitigate to certain risks in the weather, which are calculatable. So there are platforms, there are providers which help you out with frequencies and likelihoods on which deviation on your contracts are possible.
Well, and then you can go cross commodity, right? You can go into gas with a peaker. You can go, you can internalize some of that risk on the flexibility side, like you buy PV, you buy flex. That's already a physical hedge. You can come up with a hedging ratio, hedging strategy for that. So I mean, I guess there's multiple ways of dealing with that problem. But I mean, if you run a book that's supposed to hedge these risks, that shouldn't be news to you.
On the big picture, maybe ending in this direction, you said the ESG premium is dead, Max, and there's as well questions here around what is the future demand actually for PPAs, and would love to get Libby's view on this. How do you see the midterm perspective for industrial demand for PPAs evolving, and is the ESG premium dead? What does it mean for prices, and what are our clients actually asking for right now?
Yeah, that's a super relevant and interesting topic. I think it's obviously hard to answer. There's a lot of regulatory uncertainty, which has inevitably dampened demand around the price for industry conversations. I think whilst we are working towards the sustainable or the EU climate targets towards 2030 and 2050, there is a customer appetite for or to stay on track and to be procuring green power. And also it's not only it's a regulatory measure, but it's also for our customers, it's a part of their brand. And we're seeing strong interest continuing as a result of that.
And there's still a lot of first-time PPA clients, is that right? Or how do you see is there a shift in terms of different companies being interested now, others maybe not anymore?
I think no clear trends in the sense that obviously the large corporates remain interested and remain as a strong contender. And I mean, it's no secret, obviously, in the sense of data center growth around the world is obviously vast, and that remains a significant bid in terms of corporate demand for green power. I mean, you can look at any headline this year and you can see strong ESG targets from numbers of global companies. So I think, yeah, within the larger customers, of course, I think that's also translating to smaller customers, and especially when we see combinations of price efficiency of renewable assets, e.g. rooftop solar, that's a hugely beneficial component for customers as well.
Yes, it is.
So we're seeing a lot of commercials and industrials interested in renewable power, but not because of the ESG component to it, but because they're actually sophisticated enough to understand that if they have a bit of demand side response, a bit of flexibility behind the meter, they can actually capture a forward flexibility premium by buying renewables. So this is why I'm saying, you know, the commoditization here is key. It's all about cost. It's all about, you know, making the system work. And what we have in the system is a lot of renewables, and this is a very good thing. This is where we want to go. But this is not where we want to go because someone in Brussels says this is where we should be going. But this is, you know, where we want to go because it makes sense also commercially, and just because it's going to be a good trade, a very, very good one. So this is why I'm so adamant about this, and also comfortable in saying the ESG is that the premium is not relevant anymore, or it still is kind of, but it'll phase out. I'm quite sure about that.
Yeah. We'll lead this back. I mean, as I said, we want to scale things. simplification should help and adoption as well. On the other side, part of the simplification as well, that PPA, the GOO part is not included in our trades. Yeah, we have a healthy platform for GOO separately, but yeah, thinking wholesale, thinking standard, these are separate things and require separate pricing, separate regulation sometimes as well. So we'll pursue in this direction. Maybe just summing up a little bit, we get a lot of questions about where we're active regionally with this. So we start in Germany. I mean, clearly highly liquid market with big need for such a product. And we are in discussions rolling out additional countries. So the concept of the enwex index is adaptable. So we can go Benelux, we can go Spain, other countries. We haven't set up a roadmap yet. So there's more to come. Summing up, I can just thank you all as participants. I think it was an amazing hour we spent together. A lot of questions we couldn't address, so apologies to the audience who was so active here. I hope still that everyone learned something like I did. If you're really interested in product, reach out to us, reach out to enmacc through the website, through me on LinkedIn, email, or whatever. Love to continue the discussion. And we will continue this discussion as well with another webinar. I'm sure, haven't set up a date yet, but we are looking forward to this launch and helping scale the market.
Hey, this was a lot of fun. Thank you very much.